So you can see there's a clock ticking, and the way I would encourage you to use this, if you really are interested in going home and then watching the video, is when I'm talking, if at some moment in time you feel that there is a topic which is unclear to you, you note down the time. So tonight, if you have the time to watch that video, you just scroll forward to that point and you just listen to that segment. Otherwise, you're going to be listening to like 2 hours of video, and no one wants to do that. Okay, just a little tip for you. Now, so welcome everyone, and so today what I'm going to do is we're going to have a double session, and hopefully I hope that I can let you guys get out of here by about 5 o'clock. I know that we've all had a long day, and so let me just get going. Not turning on the aircon, just increasing the airflow. Now I'm going to just very briefly give you some details on the housekeeping. I want to make the key focus of this session as a Q&A session. So I have received a few questions from you guys, and I want to thank all of those who took the trouble to write to me. I'm even going to give you some participation points for doing that. I know who they are. Now, I have prepared some notes on various topics, and some of them I will go through, and I may go through them in the course of actually answering your questions. There is a concept check near the end, and you are welcome to take a look at it. This file is already online. It's already in Blackboard. Okay. So just to start with, so Chris Lee, so that more about the calendar. I have put on YouTube some other footage. So this is Green Shoe, which actually has 3 segments that I put together across 3 different tutorials. And there are some comments that I made in addition, which starts at 25 minutes, 23 seconds. If you want to check that out. Last week's tutorial was already online. I have a segment on structural versus contractual subordination, which you can also read or listen to later on. Okay, now on housekeeping, so the next lecture will be next Saturday. We all know that. As for the tutorials, I think I will still run these, but I'm going to make it voluntary, just to give you a break. All right. So if you don't want to come next week, don't feel you have to. I don't mind, but I'm going to send out a form for you to fill in. So if you say that you will come, I hope that you will come. Okay. But if no one wants to come, that's all. Just take a day off and go to the beach. Okay. There's a one-off lecture change, but don't worry about that. That's later this month. We're going to be in. That's on a Sunday. That's because on January 27th, Chris Lee actually is not available. Okay. So for that Sunday, we will be in We'll be in YALT9, which means on that weekend, the tutorial will also be in YALT9. Okay. Now the exam tomorrow will be downstairs at 9:45. It's going to be for 2 hours. Okay. There will be a seating plan. You will see that. You will see that as you go inside. the whole. Okay. Just very quickly regarding Mr. Chris Lee. So I've said this like 3,000 times, I know, okay, but this time I'm serious. I always was serious, but this time I'm doubly serious, okay? Please come to the right class, okay? Don't come to class A one week and class B the next, because there is a seating plan. He wants to know everyone. So if you are from class B, actually you will be right here, okay? There will be a seating plan. If you are from class A in the morning and you join class B, there is not even a seat for you, okay? And we're going to divide each class into 8 groups of roughly 6 or maybe even 7 people. It will be random. And starting January 28th, not 20, 28. So 1, 2, 3, 4. So each week we will look at 2 cases, and we will invite 2 working groups to present on those 2 cases. And every week there will be a quiz, including, by the way, I think January 20, he's going to give you a quiz at the end. So there will be 5 quizzes of 5% each. So that is 25%. But guess what? There's no final exam for this. Okay? So people are smiling. I don't know why. So after tonight, okay, in less than 24 hours, then there is no more exam for this course. Okay. So each session there will be 2 groups presenting. Now you don't know who will be presenting, so there will be 8 teams. 1, 2, 3, 4, 5, 6, 7, 8. So I will let you know 2 weeks before. It's not going to be team 1 and 2, team 3 and 4. It's not going to be like that. It'll be random. So every team will get 2 weeks to prepare, just to be fair for everyone. Okay. And every presentation is around 40 minutes, so everyone needs to talk a little bit. Okay. And he likes you to dress for the occasion. But actually, we will meet him the first time next Saturday. And you need to collect the cases, actually. So we'll give you 2 copies per team. I'm sorry, because we actually have to buy them. So they are quite expensive. So I hope you don't mind sharing. So there's a weekly quiz. So that is 25% plus 10, that's 35. Okay. So the other 15 are mostly participation, attendance, tutorial, and so on. There will be a seating plan and there will be name tags. It is important you come to the right class for another reason. Part of the quiz, and I believe we may be the only course doing this, part of the quiz is actually at a group level. Have you ever done that before? You do a quiz in class, but you can discuss with your teammates. Not the team on the next to you, just your own team, okay? So you really need to come to the right class, okay? Everyone is okay with that? All right, now let's get serious. And if tonight, when you watch the video, you want to jump straight to the content, so start from about 9.5 minutes. So this is when we start after the housekeeping. All right. Now, the way I want to do this, I think the first thing I want to say actually is regarding the CB market. Actually, this reminds me, and it's not just for your midterm, but I just want to share with you some things that is market practice. Now, when you look at the international CB market, like in the United States or even Hong Kong or Europe, okay? So quite often, the conversion premium, and I hope you know what that means by now, conversion premium would be somewhere between 125 to maybe 140%, like that Twitter trade you just saw. So that is to say, if on day one, when you issue, if the share price at that time was, let's say, $10, so typically with CBs that are issued in the US, so the conversion price or the strike will be somewhere around $12.50 or maybe to $14 or $15. Have you noticed something quite different with the Chinese CB market? And Rose also mentioned that too. Okay. Where do you normally see the conversion premium? It's very, very small. Sometimes, let's say 2 to 5%. So that means on day one, when the CB is issued, maybe at that time the price was $10 and the strike can be $10.50, let's say, so that's 5%. So it's very, very close. In other words, when they issue CBs in international markets, typically it's fairly far away, or what we call out of the money. So you must know by now what that means from derivative markets. Whereas in China, it's quite often, well, the term I like to use is near the money. You don't see that, okay, I'll write it out in full. You don't see people, OTM sometimes they do, but it's near, you know what near the money means, right? So it's very close to the spot price. It might be just slightly out of the money. Sometimes it's at the money. And in fact, this morning, someone presented a transaction when a CB was issued in the money. So that means at the time the CB was issued, share price might be 10. If it's at the money, the strike will be 10. If it's in the money, guess what? The strike price might be $9.50. Are you with me so far? Yeah? So you get what I'm saying. Now, of course, I'm just telling you this as an observation, okay? Now, the most interesting question, what's the most interesting question? Most interesting question is why? Why does this happen? Okay. So I just told you, hey, look at this, check it out. Okay. Then your natural reaction should be, oh yeah, well, isn't that interesting? But what is the reason behind it? I think they are different markets, and my guess is that the intention of the issuer is different. Okay, so in overseas markets, when they issue CBs, so what does that do? Okay, so when you issue a CB so one of two things can happen. Okay, either is converted, so that simply means you get to sell shares at a higher price, either that, or is not converted, in which case you borrow at a lower rate. Sounds fantastic, doesn't it? That's one way to look at it. If you're an optimist and you keep thinking of the good things, well, these are the good things of a CB. What's bad about it? What's bad about it is there is some uncertainty. You don't really know what would happen at the end. You don't know whether you're going to be paying back. Now, so that's the international markets. I think in China, when they issue CBs, they're actually thinking of something else, which is, and this might not apply to all the issuers, no, but a lot of the cases why they issue at the money or even in the money, okay, is they want you to convert. They actually want you to convert. They want you to become shareholders. And the evidence of that, I go back to this slide here. Look at the remark at the bottom. So regulators have increased restrictions on placement in preferred stocks, encouraging listed companies to refinance through convertible bonds. I agree with that statement. And I'm trying to relate that remark to why the Chinese CB market is actually quite different. Is everyone okay with that so far? Okay. So they actually want you to convert, and if you don't convert, so there is a far more the motivation for you to become a shareholder is far stronger, I think, with Chinese issuers. Now, what if it's not converted? That means that the stock price keeps dropping, for example. Well, then they just borrow cheaper. Okay. You know what I'm saying? Yeah. So this is beyond just understanding what a CB is, but trying to think of the commercial features of it, or investor psychology. Okay. Now, let me. So the way I'm going to do this today is, so I have prepared some notes, as I said. So I will quickly go through this, and I really mean quickly. So here's a quick recap on CB. So I will come back to that, okay, what a CB is and how it works. How do hedge funds actually invest in CBs? I think this is an important aspect, and unless you understand this part, it is quite hard. Or I should say, when you understand this part, a lot of other things regarding CB investment will start to make sense to you. Okay, so we'll spend a little time on this. Now, what is a call spread? We'll go through that later on. Okay. What is equity swap? I have made some notes. They're not hard to read. Essentially, an equity swap is one, it is an equity derivative, and two, it allows you to take an exposure in a certain stock. And I should put in brackets a leveraged exposure. So it is, in that regard, it's a little bit like a futures contract. It's like an equity future. So you can think of it like that. So an equity swap has some similarities to a futures contract. Okay. So there are some notes here. So we'll come back to this. And then there are some notes on the country garden trade. And I wish I can really talk all afternoon on this transaction. It was just such a classic trade. But there are some notes that I have prepared. We might come back to that, and we might even come back to that next week if you want to come for the tutorial. I will explain to you in much greater detail, okay, how that trade actually works. There are some concept checks, and this is not actually the complete list of everything you should know, and I'm not saying it is, but if you go through these slides and if you review these things, and if you are able to answer these questions, now I am not saying these are the questions in the midterm, all right? But if you can answer these questions, I don't think you can fail. Okay, let's put it that way. And then there's the follow-on offer. So again, I'm your tutor, so I'm trying to help you. I'm trying to help you with your revision. Okay, so that's part of it. So this is a checklist, and there are some questions. Okay, so ask yourself, do I know the answers to these? All right. Likewise, debt capital markets. And then there's equity link. So there's a list here, so you can review it later on. I didn't do anything for renminbi internationalization because that part is so simple. I think you can just read the notes. And so now I'm going to go to the questions, and I'm going to first try to tackle question 1 here, okay? And question 1 is this. So dear Sam, I have a question regarding bond issuance. I know bond price goes up when interest rates go down and vice versa. Yes, that's true. So corporates will most likely issue bonds when interest rate is low. Yeah. So my question is, what exactly is that interest rate? Is it the bank interest rate, government bond interest rate, or rate of the market where the corporate is in? Well, this student already had a good idea. It's the last one, okay? And I made the example here of, let's say that let's take the US example. So I've got a curve here for the US government bond market. So the x-axis is time, and the y-axis is the yield. So let's say there's a 30-year bond. This will be the 30-year yield. So normally it is upward sloping, not all the time. And let's say IBM is the corporation we are thinking of. So IBM also will have its own yield curve. Now, that is assuming that IBM is an active issuer in the bond market. If they are not, then no, there will not be a yield curve. Okay, so let's say they have a bond, they have a 30-year bond, and they have a 2-year bond. and they have a 10-year bond. So these are the most important points on the yield curve. So if next week suddenly they want to issue a 5-year bond, investors will have an idea of what kind of rate they think would be reasonable just by doing some kind of interpolation. Okay, so so what exactly is the interest rate? Well, you know what? It is the whole thing. This whole thing. So this is called a credit spread, the corporate credit spread, okay, which actually can change from time to time. And then there is also the risk-free component. Now this one also can change. If you have been keeping an eye on the news, just as recently as maybe 2 days ago, so there was a US Treasury bond sell-off. You see, I haven't even finished typing, already it knows what I was thinking of. So the US government bonds, they were selling off. So that means the bond prices were dropping, eh? And bond yields were on the rise. Now, this is often not a very good thing. So bond yields are rising, interest rates are going up. Nobody likes that unless you want to buy some new bonds, then it's good. If you're a borrower, you certainly would not like that. Sorry, let me just close all these down. Except this one, maybe, because I want to come back to that. So shut this down. I will come back to this for a reason. So shut this down. This one we already talked about. So yes, it's driven by the total interest rate, which is a combination of these two elements. Is everyone okay with that? Yeah? All right, so let's get to the next one. It gets better, okay? It gets a lot more complex. Good afternoon. I am writing to ask you several questions. What exactly is an equity swap? In the case about the Country Garden and Merrill Lynch that Ms. K referred to, she's not Ms. K, she's Professor K to you. Okay? And she's not Mrs. K, okay? K is her own maiden name. Why is Country Garden a long position and Merrill Lynch a short position? Okay, I'm going to come back to that, but let me answer question 2. What is the difference between a CB and an EB? I Googled them and found they are all bonds in exchange of equity, and I want to know more. Well, yeah, sometimes the internet is not your answer to everything, okay? So I'll let you know. On page 24, lecture 4 notes, it says that cash management can give balance sheet flexibility. What does BS flexibility mean? You gotta be careful with the word BS, okay? It can stand for bullshit. Or black shows if you want, okay? Yeah. So BS, okay, we'll come to that in a moment. Now, on question 2, what is the difference between convertible bond and exchangeable bond? So let me try to clarify on that. These are the notes that I made in the morning, so I will try to let you have a copy as well. Can you read that? Yeah. So if you look at all the equity products, equity linked products that are out there, now I would define them, and this is only one way of looking at things. Okay, so they can either be what I call bond-based, or they can be standalone. Now, don't go online and try to look for these terms. You won't find them because it's just what I came up with these words. Different people might call them different things. It doesn't matter. Okay. Now, what I mean by bond-based is, so when you invest in that, you've got to pay $100. Okay, you've got to pay par. And in this category, there are CBs. Now, CB is when a company issues a bond, Country Garden, okay, and the shares underlying also belong to that company itself. So Microsoft issues a CB, convertible into Microsoft shares, or Country Garden does the same thing. That's a CB. Now, EB is different. EB would be when, let's say, Temasek issues a bond. So they are the issuer. You give them your money, but it can be converted into the shares of another company. There was a trade this morning. Somebody, it was an EB. I forgot who was the issuer. But the underlying shares were PSBC, Postal Savings Bank of China. Do you know of that trade? I forgot who the issuer was, but it definitely was not PSBC. Okay, so that would be an example of an EB. You see the difference? Yeah? Can you tell the difference now? EB is when the issuer, so you give them your money, but at maturity, either they pay you back par, or you can convert to the shares of somebody else. Okay. Now, in the standalone market, so you can have stock options, and this is a little bit like trading futures contracts. So you can go to an exchange and actually buy or sell options on Amazon, on McDonald's, on Microsoft, on Alibaba is very active. And you go to an exchange, a futures exchange, an options exchange, and you do that, and you don't even know who is the buyer on the other side, but there is somebody, okay? But you don't need to worry about that. So that's when you are trading stock options, okay? So you're trading in the exchange. Warrants is when there is actually an issuer who are selling these options to you. Now, what kind of issuer? Someone like Merrill Lynch or UBS or Macquarie or Credit Suisse. They used to be very active in Hong Kong. I think some of them still are. Or BNP. Okay? So they are the ones actually issuing these options. So you're not trading through the exchange. You are buying products where they are responsible for. So when you make a claim, you claim against them. Okay? When something goes wrong, you chase them up. Okay? So that's a warrant. So a warrant basically is a stock option where there is an issuer. Now, of course, this can be for investment. So I already mentioned like Merrill Lynch or UBS or Credit Suisse. Right? So it could be that sometimes there are, employee stock options. So these are also stock options. but that's a small category. Okay, is everyone okay with that? So it's just a very brief overview of equity-linked products, whether you are trading them as part of a bond or you are trading them just by themselves. Okay, so that is question 2. Now question 3, on page 24, lecture 4 notes, it says that cash settlement can give balance sheet flexibility. What does BS flexibility mean? First of all, let me look at lecture 4, page 24. Oh, not here. So lecture 4, page 24. Indeed, it says can give balance sheet flexibility when your CB has a cash settlement option. Now, what this means is as follows. So you have to try to understand. Now, here I give you a simple example. Let's say you issue a CB, and at maturity, so you pay par at the beginning, and at maturity, it is convertible for 10 shares. So that just means your conversion price is $10 per share. So at maturity, one of two things can happen. Either the share price goes to the toilet, in which case you don't convert, so you just get your money back, you get your par value, okay? Or, let's say at maturity the share price goes to 14. Let's just say it does, okay? In which case you will convert. Now, if it was physical settlement, then the issuer will need to give you 10 shares. That's what physical settlement means, which by that time will be worth $140. That's physical settlement, physical, okay? What happens with cash settlement is that at maturity, so this is cash settlement now, okay? So you give them back your CB, and they give you back your par value. And not only that, the issuer can see that because the share price is now $14 and your strike is $10, so you've actually made $4 profit per share. So they will pay you this. Now that's what cash settlement means, okay? So they pay you your par amount and they pay you the profit that's been made. Now, the two things to think of is, number one, the economic results are nearly identical, okay? So here, when you have 10 shares, you could just turn around if you want to, go to the market, sell your shares, and you will get $140 in cash, and minus your initial investment, so you've made $40 profit. Now here, if it was cash settlement, it would be the other way around. So they've paid you $140. So if you really want, you can turn around, go to the market, and you can buy 10 shares. Are you with me? So it looks like there's no difference. Well, I think the difference is to some extent operational, at least from the investor's point of view. Okay, now from the issuer's point of view, and that goes to the heart of this question, what does BS flexibility mean? From the issuer's point of view, you imagine you are the issuer. If it was physically settled, you actually have to issue some shares. You have to issue new shares, or at least the company has to find the shares from somewhere. Okay? And so basically, you don't have much of a choice. You just have to issue. Whereas here, you just pay cash. You don't have to issue. Okay, now this is money. This $40 really is money from my pocket. If I was the issuer, okay, so you really have to pay cash. So that's not good. What is good is that you don't have to issue new shares, and normally issuers don't like doing that. And the reason they don't like doing that is it's going to dilute your shareholder base. No issuer in their right mind would like to issue new shares and dilute the equity base unless they have huge projects in mind and a lot of ambitious plans and expansion. Otherwise, normally dilution, let's put it this way, dilution is never a good thing. Okay, I don't think so. Okay, so here you have the flexibility. You just pay cash. And in fact, what can happen is, you imagine you are the issuer, and you just issue the CD, and it's cash settled, so you know you're going to be paying $40. Okay? It could be 40 million. Okay? I'm just missing out. So $40. So you could actually go to some investors selectively. Okay? You imagine this scenario. So you know that your CD will be converted, but it's cash settled. So you talk to some investors and you say, hey, I know that you're going to convert, and it is cash settled. Okay? So how about we try to do a follow-on offering where instead of me paying you $40, I'll give you some shares. So you have that flexibility now, don't you? Okay? You don't have to. I'm not saying you have to do that, but you can. Yeah. So that's what flexibility means. So I will come back to question number one. Okay. Now for this question, which is actually quite long, so I have an idea, which is I'm going to split the screens. I'm going to split the screens. I will ask you guys to sign, please. Please don't sign in for someone else. Not really worth it. Where is it? I think I have that somewhere. Oh, here we are. So you just have to scan the QR code and then type in your details. Okay? Try not to sign in twice, please. Try not to do that. And then in the meantime, I'm gonna No, actually, you know what? We can do that later on, first of all. Now I'm going to start. So the video recording today will be divided into two parts. There is a part A, which was what you just heard in the last hour or so. So part B is where we are starting now, okay? So tonight, when you go back, if you want to listen to it, you can. And I'm going to give you just a few minutes to read this. There are quite a few questions. I'm going to begin with, dear Sam, sorry to bother you. No, it doesn't bother me at all. When you don't write to me, that bothers me, okay? Because either you know everything or you don't want to ask questions. Okay, so it doesn't bother me when you write to me with questions. I'm a bit confused with the conversion ratio and the parity. If I didn't understand wrong, it was taught in class notes as the issue size divided by the conversion price. Kind of. Parity is the percentage of conversion value divided by issue size. All right, don't worry about all this, okay? I'm going to make it simple. Let's make it real simple, okay? So when you buy a CB, when you buy a bond, there is this thing called so let me explain the terminology of CB in a very simple way. Just close your eyes if you feel dizzy. So CB terminology, okay, and you will find this very simple. Now, so first of all, when you are buying a bond, any bond, okay, there is this thing called face value. That is just the value of one bond. So that can be $1,000, or let's just say 100. Let's just keep it simple, okay? So you buy one bond, it's $100. It can be $1 million, doesn't matter, okay? So one bond is $100. So that's the face value. And at maturity, you can convert that into, so convertible into, let's say 4 shares. Well, I could actually say it another way. I can say convertible into shares with a strike of 25. I'm saying the same thing, but I'm saying it in a different way, right? So you can convert it into shares at a contract price of 25. Now, what does that mean? That means one bond can convert into 4 shares. So one bond can convert into 4 shares. Now, there's nothing complicated about that. And let's say right at the start, the share price was $20. Okay. Now, with these simple numbers, already you can talk about a lot of things. So first of all, the conversion ratio, unfortunately, that's not really a ratio. That's why people get confused. So the conversion ratio is how much? It's 4. Okay? Conversion ratio is just how many shares you can convert into with one bond. What do I mean one bond? Well, I just told you the face value. Okay? So either you get this back or you can convert. So the conversion ratio is 4, number one. Okay? Now, let's imagine that today, the share price is $27. Let's just say it is 27 today, the share price. Now, this CB has not matured yet, okay? So parity is, if I was to convert today, if I do that, okay, how much would it be worth? Well, you can see that because if you convert today, you get, I mean, you won't, but if you did, okay, you're going to get 4 shares, which is going to be, how much is that? 108. So your parity is 108%, or $108, okay? But it's 108, that's parity. Now, if today the share price was 15, so it goes down the toilet, what is your parity value? 60. It's not good, right? But it's just a number, okay? So what does it mean if parity is 100? Either you convert or not, you don't care, right? Because either way, your bond, at least at maturity, will be worth exactly the same as your share price. Is everyone okay with that? Now, there's more you can say. There is this so-called conversion premium, and that is simply dividing the strike price by the starting price. Okay. So if your strike was 25 and your share price at the beginning was 20, then the conversion premium, well, I guess it's 20%. That's what people would say, not 120. Okay. Oh no, 125. Sorry. Or people will likely just say there's a 25% conversion premium. I think they ignored 100. Okay. Are you with me there? Everyone is okay? Yeah, so now everyone is on the same page, I hope. Okay. So don't worry. Yes. Issue size divided by the conversion price. Well, if you have a company issuing, if the issue size was 500 million and your conversion price was $12, you're going to get a huge number. Right? I think there may have been a misunderstanding. What the way this would be consistent with what I just said is if you divide the issue size, okay, by the strike, multiplied by the total number of new shares, then you will get a similar number. So the conversion ratio should always be, well, I gave 4 as an example, okay, just now. So 1 bond converts into 4 shares. It should always be, 4, 5, 10, 20. It wouldn't be a million, okay? The conversion ratio wouldn't be that kind of a number. The conversion ratio is simply when you surrender your bond, okay, how many shares will come back to you. So if the issue size was $5 million, sorry, 500 million, okay, then you need to multiply this strike by the number of new shares that it can convert into. Okay, then you get the conversion ratio. Maybe I'll just show you something. All right, then it's easier. Can you see that? For example, so don't worry too much if I'm sorry there was a confusion, but just try to reset. Okay, try to unconfuse yourself. That is the easiest way to think of it. Okay, so for example, 1 bond, maybe what does 1 bond mean? Well, I told you already. Okay, that can convert into 20 shares. So the par value in the US, the face value is 1,000. It is true. So if your strike was 50, then one bond will get you 20 shares. So the conversion ratio is 20. Okay? All right. So parity, I already explained. Now, can you please explain page 12 and 13 from the 4th lecture? Yes. What's page 12? Well, what is it that needs to be explained? Because I think it's running out of time for Professor Rose. It's not Miss K, it's not Professor Rose, it's Professor K, okay? It's not Miss Rose either, okay? Just kidding with you guys. Well, this is kind of explaining to you how, under what are the motivations when an issuer wants to issue a convertible bond. Now, this might actually be a good point just to explain a little bit. I'll show you that one more time. Why a company might want to issue a CB. Now, it could be that they issue a CB in order to try to acquire another company. So I think in one of the presentations, we already mentioned that. It could be that they are high yield and they want to pay a lower yield, okay? It could be opportunistic. Now I'm going to try and talk around some of these issues. And before I do that, I'm going to just spend a little bit of time explaining to everyone how a CB actually, how it works, okay? And the way it works is like this. So let's say, made a lot of notes today. I'm trying to find it. Okay, so you imagine there is a company, all right, and company X, and they try to issue a bond, and let's just imagine that if it was a vanilla bond, they would be paying a 5% yield. Vanilla bond, okay? No calls, no puts, nothing for 3 years. So that means, so if you are familiar with fixed income, they need to pay, if they pay a 5% coupon in year 1 and year 2 and year 3, then that bond will be priced at par, all right? Now that's a vanilla, a straight bond, so to speak. A CB is simply taking the vanilla bond and then saying to the investor, well, look, maybe I don't pay you 5%. So instead, I just pay you 3%. So the investor will ask, well, look, for your company, for me to lend you money for 3 years, I want 5%. So where's my extra 2%? It's not even extra. Where is my 2%? So what they do is they will say, well, I don't pay you that 2%, but we're going to present value that 2%, which will be somewhere around $5.50. It won't be $6, okay, because it's PV. So for that, $5.50, we will give you a call option, okay? That's all it is. That's what a CB is. It's a bond with a reduced coupon plus a call, okay? Now, even though it is a very, very simple financial product, already you can see there are a lot of subtleties and different ways you can play around with that. Now, the first thing I can say is that, so I just told you that for this issuer, instead of paying 5, so now they pay 3, and then the other 2%, they give you a call. That's not the only way, okay? Another way is maybe you pay nothing. In year 1 and year 2, you pay nothing. It's called a zero coupon CB. So where's that 5% gone? Well, they will give you a call option, but it'll be a much more attractive one because now it's a more expensive option. So maybe the strike is a lot lower. Okay. So they can do that. There's even another way to play. Okay. And so what I just described is the first alternative. A second alternative may be, well, I don't pay you that 3% coupon, and I don't give you a really fantastic call option either. But at maturity, I'm going to give you back, let's say $10. Now, this $10 is essentially it's the future value of that 3% for 3 years. In fact, this morning someone presented a transaction. It was Eric, I think. Zhang Yifang, you know him? Huh? Yifan, I'm sorry, yeah, Yifan. Is Eric, anyway, okay, Eric's easier. So there was a CB where there's no coupon, but at maturity, you may get back 110. Or you might convert, okay? Now, this is actually called, there's a name for it. It's called premium redemption structure. So you are redeeming not at par, but at a premium, okay? Is everyone okay with that? Okay, so that's on CB. Don't think it's complicated. It isn't, okay? So I'm guessing that, well, I think when you issue CBs, it's one of two things, okay? And either your share price is very high, or you think it's high, okay? And then when you issue a CB, let me put it another way. So when you issue a CB, one of two things can happen. So either, if it's converted, you get to sell shares, normally at a higher price, maybe not in the China market, and we discussed that earlier today, the reasons. So either you get to sell shares at a higher price, or you get to borrow cheaper. Now, isn't that a wonderful deal? So either way, it looks like it's a win-win-win for everyone, okay? So opportunistic can mean if you are an issuer, if you are a company, and you see that your stock price keeps going up and up and up, and you issue a CB, okay? Now, I'm trying to get into the mind of that issuer. Imagine you are the treasurer of a company and the stock prices keep climbing, it's about to hit the roof, and you issue a CB. What do you think he or she might be thinking of? Quite possibly, the stock price is going to do this. So you just want to borrow cheap. You don't think it's going to get converted, for example. That would be an example of an opportunistic issuance. And some of your presentations actually were touching on that. Okay. Now there's an alternative scenario. So the price was like this, and suddenly it's like this. Okay. And you issue a CB at this point. Why are you doing that? Because you don't want to issue shares at this price. It's so cheap. And you think there is a chance that the share price can go back up. And then you can sell or you can issue shares at a better price. This is way too cheap. Okay? Now, Country Garden was precisely that. Or at least that's what they were thinking, okay? Of course, the share price can keep going down, and it did in the case of Country Garden, but that's a different story, okay? So I think that's what this can mean, all right? On page 28 of lecture 4, what does it mean by poison pill? Yeah. This is actually related to a question called investor put, okay? Now, what is an investor put? First of all, now an investor put, and it normally applies to bonds, not just CBs, okay, but normal bonds as well. That is, under some conditions, when a bondholder, when a bond investor, this is bond investor, a bond investor can go to the company, give them back the bond before maturity. Okay, so normally you can't do that. Before maturity, they give the bond back to the company and say, I want my money back. I want my par value. I want my $100. Thank you very much. Okay. Now, what kind of investor puts out there? Well, first there's what's called a delisting put. Okay, that's one kind. That's when your company is not even listed in the stock exchange anymore. So bond investors get nervous. They say, what the hell is going on? Okay, so we allow you the right, if you want, to get your money back. Okay, another kind of put is called change of control put. Now, this is when the management of the company or the control, the major shareholder, actually changes, which is when it gets taken over by someone, for example. Okay? And there are some bonds which would have this clause which allows the investor to go back to the company and say, hey, your management control has changed, so I want to put the bond back to you for $100 or $103 or whatever, okay? Now, this is called a change of control put. I think it does two things. The first thing is it gives the investor some comfort, because change of control is a big deal. If I buy a company, the bond of a company, and it's controlled by, Johnny Smith, and then next year it's controlled by somebody else, how do I know what you're going to do? Okay, so it allows me to put the bond back to you. But the second reason is it's a kind of defense mechanism. It's a takeover defense, because then if somebody wants to take over that company, they will see that, wow, if I take over this company and the management changes, or the controlling shareholder changes, okay, then I'm going to have a lot of bondholders knocking on my door saying, I want my money back. So I better make sure I've got the cash to pay them, okay? So they're going to think quite carefully before they do that. And this is known as a poison pill, okay? It's a kind of takeover defense. Takeover defense. Defense strategy. So poison pill is a kind of takeover defense strategy. Okay? Now, on page 30 of lecture 4, we see the dividend pass-through structure is to stabilize the option value by adjusting the stock price. I think it's beneficial for the investor because it prevents option value from decreasing. It is true, I agree with that. But why the note said it's better price and terms for the issuer? Okay, I sometimes get these questions because just reading this in this context might be hard to understand. Okay, now, first of all, allow me to discuss what this is. And I'm grateful to Rick because I'm going to go to his presentation in a moment, okay? Dividend pass-through is actually a feature that you find in some CBs. Not always, but in some CBs, okay? Now, what it means is, so when you look at stock price, okay, and dividend, when the dividend goes up, what happens to the stock price? The stock price goes down, right? To give you an extremely simple example to think of, if a company is worth $100 today, and I pay you a $2 dividend, or that's what that's what you're expecting. So after I pay you $2 dividend, the company is only worth 98. You haven't lost any money. That $2 drop in share price is actually in your pocket. That's all it is, okay? But if you invest in call options, you don't enjoy that $2. It's for shareholders. It's not for people who have a call, okay? So naturally, if you have a call option, you are not really happy about that. In other words, when dividends goes up, the stock price goes down, and call price also goes down. Now that's okay, because when you look at option pricing, and this is my old friend, optionprice.com, okay? Now this is a very, very simple option pricer. I'm going to price a stock with a strike of 100, and the underlying price now is also 100. It's a 1-year option. I'm going to just cut out interest rates, okay? So dividend yield is 1%, and I'm going to hit calculate. Just look at the call option, okay? This option is worth $9.41. That dividend yield is an input, but unlike in the bond world, so for stocks, dividends can change. So how do you actually price this? Well, I just assume it will be 1%. All right, so there might be a market consensus, but in the end, it's something that you have to put in as an assumption. Now, let's say the company just goes wild and suddenly they say, okay, this year I'm going to pay 6% dividend. Okay, so this is completely unexpected for shareholders and for CB investors also. Okay, now if I hit calculate, watch what happens to the call price. It was $9.41. It's now $7. So if you are investing in a CB which contains a call option, are you happy about that? You're not, right? You cannot be happy about that. So the dividend pass-through is not actually a payment that they make. The dividend pass-through is they will say, well, all right, look, if we increase the dividend yield to a certain level, and they will define these very clearly, okay? But if we do that, then we will make some adjustments to the exercise price. Okay? So let's say we adjust the exercise price, the strike price, I should say. The strike price, we're going to adjust it down to 97. So when you hit calculate, you can see there's some compensation. Or maybe they adjust it to 95, who knows, okay? It's all negotiable. So now if you do that, so they're happy, oh shit, the dividend yield was 6%, but they adjust the exercise price. Now, ladies and gentlemen, that is what dividend pass-through actually means. Is everyone okay with that? You adjust the strike price or the conversion price. Everyone is okay? You can see, now normally you don't do that. Of course, a call is a call. There's a strike, and then you don't adjust the strike price. But here, you do, okay? And there is no better example than the one we just saw an hour ago when Bank of China was doing precisely that, okay? So you have to read going down So the conversion price started at $4 and it keeps going down and down and down. Okay, this is the finest example of dividend pass-through that I can. Well, it's not all because of dividend, so there's a rights offering here as well. But ignoring that for a moment. Okay, is everyone okay with that? So the way it normally works is, you would expect a company to pay a certain amount of dividend. So let's say they've been paying 3% every year for the last 5 years or 10 years. So you expect them to continue. But if suddenly they pay more, suddenly they pay 7%, okay? And all of this will be in the contract, and they will tell you how they adjust the strike price. Okay? So that is... Okay, actually, I have not completely answered the question now. But why the note says it is better pricing terms for the issue? Now, it can be confusing. What this means is simply that. What does this mean? Okay. In plain English, I'll tell you what this means. Okay, so don't look at the screen. Just listen to me. It's that second bullet point. What it's trying to say is, if you have a dividend pass-through feature in your CB, it makes your CB more attractive to investors, and you may be able to sell it at a higher price. That's what better pricing terms actually mean, okay? It's a bit like if you are a car dealer, okay, so you are selling cars to customers, and then when they come, you tell them, oh, I'm going to give you the navigation free of charge. And I'm going to give you, it's not free of charge, I'm going to give you a sunroof. I'm going to give you, what can you give people when they buy a car? I'm going to give you some umbrellas, okay? So that would result in better price. It just means it makes the deal more attractive for the investor. Okay? So when you make a deal more attractive to the investor, it is good for the issuer, so it makes your deal maybe more popular, or it's likely that it can be sold, more easily. That's all it means. Okay, so maybe this point is not too clear. You're reading it like this. Okay, is everyone okay? Everyone is okay? I'm just tired. Now, can you please share more on the basis risk related to CNH, CNY? Yes, I can. So now CNH, as you know, is the renminbi market in Hong Kong. So CNY is the market in China relative to the US dollar. Now, I know they are very similar. They're not the same. They're not the same market. They are not the same value. Okay, so you can pretty much it can be guaranteed that when you have an exposure and it's based on one market. So let's say you have some money coming in, so your income is from, okay, let me give you a solid example. So somebody pays you US dollars, in China, okay? And so you sell those dollars for CNY, all right? So that is your income, okay? But for your bond, maybe your bond actually is priced in CNH. So when you pay somebody, all right, so when you get the US dollars, so your income actually is, maybe you are a manufacturer, so you earn money on US dollars, but you actually is in the CNY market. But when you pay somebody, so on the outgoing or on the liability, it's in CNH. Now these two are not the same market. So when you have two things which are very similar, but they're not exactly identical, you will be running what's called a basis risk. So this is the general term for two things that are similar, but they can diverge. Okay, that's what that means. Okay. Now let me get on to question 4. I have a question regarding CB for a renminbi denominated US dollar settled CB. How does it work? Thank you. This is a very simple question, okay? Or the answer is simple. So there are two things to consider. So the first thing is so for CB, okay, number one is the currency that it is denominated in. Now I'll explain in a moment what that means. So let's say it is denominated in renminbi, and then there's a settlement currency, and which, let's just say US dollars. It can be other things. Okay, now, so at maturity, it doesn't even have to be a CB, it can be any kind of bond, okay? So let's say at the start, all right, so there is an investor, these are notes from the morning session, and they want to invest in your CB, and they decided to invest $6.5 million renminbi in your CB. Okay, now let's say at the beginning, the foreign exchange rate is $1 against 6.5 renminbi. Let's just say it is, okay? So at the beginning, at the start, the investor actually will pay you $1 million, okay? Although both parties understand very clearly that you have actually invested 6.5 million renminbi, although they paid in a different currency. This is just for settlement, okay? So your investment, notionally speaking, is for 6.5 million renminbi. Is everyone okay with that? Now, at maturity, like I said, it doesn't have to be, it can be just a bond, okay? But any kind of bond, so let's say you don't convert, and then you just give the CB back to the issuer. Now, they have to give you back 6.5 million renminbi because that is what you invested in. And they will say that very clearly in the contract. But guess what? They don't pay you in renminbi. They pay you in US dollars. So this is at maturity, at the end, okay? So what you do is you look at the exchange rate at the end. Now that's why I say FXT, but it's capital T at the end. And let's say the exchange rate now is $1 for 5 renminbi. Okay, so the renminbi has actually become stronger. Okay, so the issuer needs to pay the investor 6.5 million in renminbi, but the issuer will not do that. Instead, the issuer is going to pay the investor 1.3 million US dollars. Are you with me there? Why is it 1.3? Well, because 6.5 divided by 5 is 1.3. Yeah? So you can see that from a US dollar point of view, well, first of all, from a renminbi point of view, the issuer borrowed 6.5 mil in renminbi, and that's exactly what they pay back. So for them, it makes no difference, okay? But from a US dollar point of view, they've actually made 300,000 extra money, okay? Now, the thing to remember in a situation like this is that your denomination is where the risk is, all right? The settlement is in US dollars. Okay, if you are a US dollar guy, you will care, okay? If you are a renminbi guy, you don't care. You don't care I pay you in yen or Swiss franc, Bitcoin, apples. Why would you care? You can just turn around and sell whatever I pay back to you and get your renminbi back. Okay, so that's the theory. All right. So settlement, you can pay in gold if you want to. Okay. So the settlement is just a medium of exchange, if you like. Okay. Is everyone okay? Everyone is okay now? You know how it works? Yeah. I was going to let you out at 5 o'clock. I don't think we can. So sorry about that. All right, question number 5. Just try and read that. Why do considerations of secondary shares include retained holdings by management key to messaging? So lecture 2, slide number 3. Lecture 2. Slide number 3. All right, this part. Okay. Now, actually, I can use the notes from this morning. Please imagine what happens. So there is a company which has already done an IPO, so it's already up and running and is trading in the stock market. Now they do a follow-on offer. Now there are 2 ways you can do that. One is you actually issue new shares. All right. So these are called primary shares. These are shares that did not even exist before, in which case the balance sheet of the company will increase. So this is primary shares. Another way is one of the major shareholders actually sell part of their ownership. So before they owned the whole lot here, but they sell a part of it. Now, if you don't have this primary, first of all, if it's just an existing shareholder selling a part of it, it doesn't actually change the balance sheet on either the asset side or the liability side. The only thing that changes, if I'm the major shareholder, the only thing that will change is in my pocket, suddenly I have less shares and I have more money in my bank account, okay? But it does not affect the balance sheet of the company unless, unlike, when you are issuing primary shares, okay? Now, that often is a signal to investors. They might think, wow, this shareholder, what are they doing? So they're not confident in the company. That's why they are selling part of it. They don't believe in their business anymore. Okay, if you sell a lot, people really can think like that, right? If you own 70% and you sell 5%, then yeah, people wouldn't think like that. Okay? If you own 70% and suddenly you decide to sell 30, people are going to think, why you need so much cash, or you don't believe in this company. A few years ago, there was a company called Li-Ning. You all know about that, right? And they did something like this, and investors did not react to it very well. Okay, they say, why are you selling a major portion of your ownership? And in the Prada IPO, which those of you who did the Chinese equity might remember, and even if you didn't, we talked about that when we discussed green shoes. Okay, it was also exclusively just a vendor selling. Now, that IPO didn't go down very well. And it's related to whether the management is retaining any stock holdings themselves and what kind of message or what kind of signal to actually send to the market. Okay. How will the increase of US Treasury yield affect domestic Chinese bond market? And I was doing my intern in secondary bond market in late 2016. It seems everyone in the market was 2016. Wow, that seems like a long time ago. Everyone in the market was talking about the potential increase in US interest rates, and they seem to be quite pessimistic. I still cannot figure why, after taking the course. Do you have any ideas? Yes, I have some ideas. Well, you only have to look at what happened 48 hours ago. Not this. So there was a sharp increase in US government bond yields, or bond prices went down and bond yields went up. Now, this is the US market. So what I've drawn here at the bottom, so the US market will have or the US government bond market has a yield curve, and China also has a yield curve, the Chinese government bond market. The Japanese government bond market, they have their yield curve, and so on. Now, unfortunately, the US, they are a big part of the world economy, and they have a big bond market. So when the yields of US bond market, when that goes up, it has a kind of spillover effect to other countries. Okay, maybe you don't like it, I don't like it, but that's just the way it is. Okay, I would even add that even in China, which is now the second or the third largest bond market in the world, so if China borrowing costs goes up, it would have a similar effect on the rest of the world. It's just a question of who is bigger. Okay, so it does have a correlation. Okay. Okay, you might want to read that. So this is question 6, and then we have one more. And then, oh, this one we already answered. So the first one we already answered just now, okay? I might answer this first, and then I will answer question 6. And then I will tell you a little bit about CBs, and then I'll let you go. Okay. Now, back-to-back confirmation letter. Lecture 2, page 20. Lecture 2, page 20. First of all, forget this back-to-back thing, okay? Doesn't really mean much. The confirmation letter from place C. Now, this is when you are doing large transactions between a buyer and a seller. There is this thing called a big boy letter. So the question is asking, what is that? Okay, don't worry about the back-to-back. So it's a confirmation from the buyer, from the equity buyer. So the equity buyer writes a letter to the seller and gives them a big boy letter. Now, this is a funny name, isn't it? Big boy letter. So in law, there is a concept called reliance. Okay, so I'm happy to share that with you. Now, reliance actually means when two parties are transacting, okay, so there's a buyer, there's a seller. It doesn't have to be buyer-seller, and I'll tell you why in a moment, okay? So, but let's say there's a buyer and seller, and they do not have equal expertise. So maybe the seller knows a lot more than the buyer. Then you can say that there is reliance in that transaction. So that means if there's something that the seller should tell the buyer, something the seller knows, and they should tell the buyer, and they don't, then later on the buyer potentially can sue the seller, take them to court. Okay? So if you are a retail investor, for example, moms and dads, uncles and aunties, and you buy some complex structured product from a bank, there is reliance in that relationship. Okay? To give you a different scenario, it's not always buyer and seller. If you go and see a doctor because you are feeling unwell, so you enter a doctor-patient relationship. In that relationship, there is reliance because you rely on him because he knows more than you. Okay? If there's something he should tell you, but he didn't, or she, okay, then you can actually take action if something goes wrong later. Now, non-reliance is the opposite. Non-reliance is when you write a big boy letter, so you basically, well, you get your lawyer to write it, okay? Your lawyer will write a big boy letter and give it to the seller. So I'm a big boy, okay? I'm a very sophisticated investor, and I believe my investment expertise is at the same level as the seller, so I will not, in the future, okay, take them to court because of things that they have not told me. That's a big boy letter. Okay? Now maybe you're wondering why, if you are an investor, why do you write that? Well, it's all about negotiation. Okay? So if I am an issuer, if I'm the seller, maybe I tell you, well, look, if you write a Bitcoin letter, I give you a better price. I give you a cheaper price. Okay? If you don't write a Bitcoin letter, I'm a little bit worried what are you going to do in the future. So, okay, I'll still sell to you because I think I have told you everything, but, I'm going to charge you more. So it's always, pros and cons. All right? That's what the Bitcoin letter is. Okay, so this one is done. And now this one actually is, just read that for a moment. We are near the end, okay? I'm writing a question about corporate hybrid from Google. The term corporate hybrid covers a range of debt instruments that lie somewhere between senior debt and equity. Well, that is true. I agree with that. Then from my perspective, it's somewhat like the convertible bond. And if my understanding is correct, why the coupon is lower than straight bonds, while that of corporate yield is higher. I guess I do not understand the concept well. If you look at the balance sheet of a company, so this is the balance sheet. So you go from the highest or the safest, which is senior secure, senior unsecured, and then junior bonds. And then you come to the hybrids, like convertible bonds and perpetuals and so on. It seems that as you go down in credit quality, the yield should be increasing. I think that's the question, okay? So the credit quality, as you go down, the credit quality is dropping, or the credit risk is rising. So why? I think the question is, in that case, how come the CB can pay a coupon which is lower than a vanilla bond? That is kind of the question, isn't it? You know what I'm saying? Well, the reason is simple. The reason is you cannot look at the CB in the same way you look at other things, because although you are paying a lower coupon, so let's say the coupon of a senior bond normally is 5%, and now you pay 3%, the other 2% has actually gone somewhere, because you are paying them the present value of that is being returned back to the investor in the form of a call option. Okay, so you cannot just look at the yield and come to that conclusion. Okay, so CB is different that way. Now I actually have some notes on what an equity swap is, which I made. So you can go home and just read that if you want, okay? An equity swap is just a leverage way for you to get exposure in an equity, okay? I will just say a couple more things and then I'm going to let you go. So the first thing is what is a call spread? Okay, I'm going to talk about that a little bit. And then I'm going to talk about how hedge funds invest CBs. I'm sorry this is the last topic, because for me, this is the fundamental aspect in understanding the CB market, and you see what I mean in a moment. So I hope you can stay till the end and pay attention to this point. Okay, but now a call spread is simply all right. I don't want you to look at all that. So because now call spread is so let's say you are a corporation and you want to issue a CB, but what you really want to do is to issue a CB where the strike price is about 1.5 times the current stock price. Now that, let's say you want to do that. And this is a little bit unusual. I know that in that Twitter deal that we saw, it was actually quite close, but I think it's quite unusual. And let's say you want to do that, and then the investment bank will give you the advice. They will tell you, well, you know what, this is actually very hard to sell because people in the market, they don't want to buy a CB where the exercise price is so far away, okay? They might buy a CB when your exercise price is somewhere around 125, let's say, okay? So you're the issuer, and you don't really want to do that. So how do you solve that problem? Something you want is something market is not something market wants, okay? So what you do is you do this instead. I'm going to go to the next page, okay? So you are the issuer, you issue a CB, the strike is 125, so that's what the market wants, but you turn around and you go to an iBank, you go to the derivative desk, and you actually buy a call option with that strike. And then you sell another one, which has a strike at 150. So now the investor is happy because they got what they want. The issuer is happy because this will cancel this one, at least economically it will, okay? And the iBank is happy because they get to do some business, so everybody is happy, okay? That's what a call spread is. So a call spread usually happens when one issuer wants to issue CB, and I'm going to put the second point separately at the higher strike. So it's worth splitting that point into two separate points, okay? So instead of doing that, they would issue a normal CB at 125, but then they would privately go to the iBank and actually try to offset that 125 option. So when they do that, so they issue a CB. Oops, this is a real example, but there are a lot of examples out there. Okay? So they sold a call at strike 125 because that's what you do when you are selling your CB, and then they buy back a call at a strike of 125, and they sell a call at a strike of 150. Okay? Is everyone okay with that? Now, I'm gonna talk about one more thing, and probably the most important part of the afternoon, if you really want to understand equity-linked markets. Okay, now, when you are, so I already told you that when you invest in a CB, so when you buy a CB, what are you buying? So when you are long a CB, okay, it's equal to when you are long a bond and you are long a call, right? Now, when you are long a bond, you can actually take it apart like Lego. This is what's so fun about structured products, or finance generally. So in a bond, there is the interest rate risk, and you can even split that into two parts. There's the government interest rate, which can go up and down. There's your credit spread. And if you are wondering how that works, so at the very beginning, we already discussed that part, how, where are the notes for that? I made some notes. Forgotten where it is now. But anyway, so when you invest in a bond, the interest rate can change after you buy. So the two risks that you run are the risk-free rate can change. Let's call it that. Okay, so it always sounds a bit academic. So the risk-free rate can change, and then the credit spread can change. Okay, and then when you are long the call, so that's on the bond part. Okay, now for the call, what are the risks? Well, the call price can change when the equity price is changing. So when the underlying stock price goes up, your call price will go up. Now, the other thing that can affect the call price is when there's a change in volatility. I don't think I need to say a lot because you already hear that every week in derivative markets. Okay, so you price something, and it is possible for the call price to change when nothing changes, but volatility changes. Look at the price. Now it's 1061. I changed the volatility to 30%. So now it's 1036, for instance. Okay. The reason hedge funds are a very important player in the CB market is that hedge funds, they really like to invest in CBs. So for most CB issues, hedge funds would quite easily account for 35 to 40% of all the subscription, maybe even higher. Hedge funds love buying CBs. Okay. Well, it depends on what type of hedge funds, but a lot of hedge funds are in the CB market. Okay. Now, the way, and I'm getting to the heart of this, okay, the way hedge funds invest in CBs is different from the way you and I might invest in CBs. Okay, now how would you and I invest? So, you buy a CB, right? So I like that credit. Okay, I like Microsoft, I like Alibaba, so I like that company. Okay. 2, I get some income. Pretty cool thing to have. Okay. 3, there's a call option. So if the price goes up, stock price that is, okay, you have some upside. Fantastic. This is not how hedge funds invest in CBs. Okay. Hedge funds like to trade only this one, volatility. Okay. So they don't want to have to think too much about the equity risk. So the term for that sometimes is non-directional. They don't care much. Well, I mean they do, but it's not their primary focus. Non-directional. So they don't want to take equity risk, and sometimes they don't even want to take interest rate risk. Now, all of these can be hedged. So you can hedge the government rate risk by just trading bond futures, government bond futures. You can hedge the credit risk by trading credit default swaps. And this is a credit derivative, and there is a course devoted to that next term. If you want to take that, we talk in a lot more detail what credit default swaps are, but essentially they are a little bit like insurance contracts. So you can buy protection on a certain company, Country Garden or Microsoft, whatever, okay? So this market is affected by the underlying liquidity. How active is it? So the CDS market for General Motors could be far more liquid than the CDS market for, let's say, Agile. Okay? I don't even know if there is a market, the CDS market for Agile. Okay? So when the liquidity is good, then your CB is more attractive because the hedge funds will know it is easier to hedge the credit risk if they want to, okay? However, they normally don't hedge the volatility. If you buy a CB and you hedge everything, it's better you don't buy it. I mean, what's the point? Okay? But they will hedge the other components, especially the equity risk. Now, how do you hedge equity risk? By short selling the stocks. Okay? So the equity risk is hedged by short selling on the stock itself, which is why when the stocks of your company can be short sold very easily, it makes your CB more attractive, at least to hedge funds anyway, okay? Because they know they can buy this bond and they can short sell the stocks. Now, that would explain, in turn, in the Country Garden transaction, why Country Garden was so keen to help Merrill Lynch, to help the investors to short sell, if they really want to. Okay, when the hedge funds are short selling, it's not because they have something against the company. It's not. Okay, they are just trying to hedge out the equity risk component, and the issuer understands that. Okay, so if you can understand what I just said to you in the last 5 or 10 minutes, you understand the most important piece of the CB jigsaw puzzle, okay, which is who buys, okay, who is the major player is hedge funds, number one. Number two, how do they invest in CBs? Well, they don't like the equity risk. Quite often they don't even like the interest rate risk, or they don't like the credit risk. They do like to trade volatility. So as a result, they will use bond futures or CDS or asset swaps to hedge the credit risk, and they would short sell stocks to hedge the equity risk, and they would leave the volatility alone. Okay, now I feel that is very important for me to share with you. All right. It is now 5:30, and do you have any questions, please? Or everyone is tired? I'm tired. If you have questions, ladies and gentlemen, even though we're all tired, I really prefer you ask me now, because if there are any questions, I want to share them with everyone else. Okay? Does anyone have any questions? Please ask them now. Okay? Instead of coming up to me individually, I really mean that. Does anyone have anything they want to ask? Please. Nothing. Everyone is quite happy. Then I wish you good luck, and I will see you tomorrow at approximately 9:30. Well, thank you so much for coming, and thank you for all your, I'm going to say this louder, thank you for all your presentations. I always enjoy listening to you talk, and well, don't go to bed too late tonight. How about that? Okay? Have a nice evening, and thank you once again. Now I'm gonna produce some videos, and I will put them online as fast as I can. Okay. Thank you. In case anyone is gonna listen to that. Now, first of all, let me explain to you what a callable bond is, because to understand make whole, you have to understand what a callable bond is. A simple callable bond, okay? Then I will talk about the make whole. All right. Now, a callable bond, let's say, is a 5 not call 3. So that means this bond, so let's say it pays a 3% coupon every year. 3%, until year 5. And let's say you can call at par. So that means at year 3, or maybe beyond, okay, if it's American style, I can call this bond back, and in year 3, I will just give you 103, which is 100 plus your last coupon. That's a callable bond, okay? Now, what is make whole? Make whole is a little bit different. Make whole is not really a call option. Make whole is you have a 5-year bond, and it's 3% a year. Okay? And I have a make whole provision in year 3. Now, if I call this bond, I shouldn't say call, if I redeem this bond, okay, in year 3, I'm the issuer, okay? If I redeem this bond, I will pay you 103, but I will need to pay you the present value of that $6 that you were expecting. That's what make whole means. Okay? So for the investor, it's quite good, because in this case, you can see that you may actually miss out on a couple of coupons, even though you get your money back earlier. Okay? So typically, if you were to compare the two, the callable bond will probably need to pay you a little bit more. Let's say 3.2. Doesn't matter how much. I'm just making an example. Okay? Because of that call feature and the reinvestment risk that comes with it. Okay? For make whole, if you buy a bond and there is a make whole provision, then you can guarantee that pretty much if you get your money back early, that's actually good news, because not only do you get your money back early, so you don't care if the issuer goes bankrupt, guess what? You don't miss out on the future payments. You still get them. Okay. I think in the American market, sometimes they do that. I'm not sure whether in Asian deals whether they do that or not. Okay. Now maybe you're wondering, why is the issuer so nice? Well, like everything I've told you all afternoon, they're not doing that to be nice. Okay. They do that because they feel they need to make their deal more attractive. Now, why do they do that? Maybe they are really shitty credit. Okay, so you do whatever you can to make the deal more attractive or to make investors more comfortable. You always do that. Okay, you wouldn't do that if you don't need to. Of course, you won't. Okay, so it's all about pros and cons, always. Okay. Anything else? It's okay? Wonderful. Oh, you're welcome.